What if I told you that keeping your money safe in the bank is one of the most dangerous things you can do? Through 9 years in banking and helping people with their personal finances, I've seen the same mistake over and over. People keeping tens of thousands in their accounts, feeling satisfied, thinking they're being good with their money. But actually, the complete opposite is true. There's over 526 billion sitting in low interest accounts in the UK right now, impacting 29 million people. And in the US, half of Americans have more than $8,000 sitting in similar accounts. All these people are losing money every single year, completely unaware about it. So in this video, I'll share why having too much cash is one of the most dangerous mistakes and what to do instead. Let's get into it. First and foremost, cash is the laziest worker you will ever hire. You know that feeling when you've just finished another exhausting week? Worked overtime, difficult colleagues, sacrificed your evenings, put in the sweat, the stress, the mental energy to make, say, $10,000, and you put it in a bank account. You check that bank account after a year, and your money has just sat there, been lazy, and hasn't created more money for you. Not only that, it's now also worth less than it was a year ago. It's the same $10,000, but you can buy less with it. It sits there motionless, doing nothing for you whilst you're out there working really hard. What if instead of putting that money in a bank account, you put it somewhere where it also went out and made money for you? That is what investing your money is. If you put that same $10,000 to work, generating 8% returns, after 1 year, it becomes $10,800. Then $10,800 in year 2 becomes $11,664. And each year from then, you're earning more money on your money. Over 10 years, your lazy cash stays at exactly $10,000. But the money that worked for you grew to over $21,000. That's more than double, an extra $11,000 you never had to sacrifice another evening or weekend to earn. Just because you put your money to work instead of letting it sit in cash doing nothing for you. Moving on to point number 2, the emergency fund trap. I know what you're thinking, but what about emergencies? You've always said we need to save an emergency fund. The point of an emergency fund is this. In a worst-case scenario, if you lost all income, do you have enough to cover living costs? That's mortgage or rent, groceries, essential bills, minimum debt payments that total multiplied by 3. 6 months for more protection. 9 months if you're self-employed or have an unstable employment situation. That is the size your emergency fund needs to be. It does not need to be more than that. When I worked in banking, I had colleagues with $40,000, $50,000, $70,000 in their accounts telling me it was their emergency fund. But when we broke down their actual living expenses, their real emergency fund was less than half of that. The rest was just spare money, sitting there, losing value every single day. Save your emergency fund in a high-interest savings account and somewhere easily accessible with no fees to withdraw. Personally, I'm currently saving my emergency fund in Plum. They're offering around 4% on easy access savings. The third reason, and I made this mistake this year, is because it will feel like spending money. Having too much money sitting in your account actually tricks you into spending more. You check your bank account, say $15,000, and your brain goes, oh, I've got loads of money. So you buy those shoes, grab dinner out instead of cooking, maybe book that weekend trip. But that $15,000 wasn't actually meant for spending. Most of it was your emergency fund or savings for a goal. I experienced this myself recently. I switched bank accounts, and for a couple of months, my automation wasn't set up. And I realized after a few months, my spending had increased. I was making impulse purchases I normally wouldn't. So I set up my system, again, money invested directly from my business account before I even pay myself. Then I pay myself a salary. From there, it goes into investments, personal savings, bills, all automated. The key is making sure your money is out of sight before you can spend it unnecessarily. If it's automatically moved into investments before you can see it, and you're much less likely to make those impulse decisions. Moving on to the fourth reason, and this is insurance won't cover you if you save too much. There is a limit to how much the government will protect you if your bank goes under. In the UK, the FSCS covers up to £85,000 per person. In the US, it's $250,000 through FDIC protection. If you're nowhere near those limits, you're probably fine. But if you're approaching or exceeding them in one account, that's unnecessary risk. The solution is to ask yourself, why is it that you need that much money sitting idle in the first place? The 5-year rule matters because the stock market can be incredibly volatile in the short term. Your investments might be worth $50,000 today, then $45,000 next month, then $55,000 the month after. If you need that money in 2 years for a house deposit, you can't afford it to be in a dip when you need to buy. But for money you won't need for 5 or more years, short-term volatility smooths out and you benefit from long-term growth. Spread short-term goal money across multiple banks to stay within limits. Everything else, get it invested. And moving on to one of the biggest reasons you become more of a target. If you're thinking it's fine, it's not going to happen to me, I'm all clued on it's not worth being complacent about. Scams are becoming incredibly sophisticated. They can even impersonate someone's voice. There was a tweet I read from Bergman. He's a multimillionaire who founded Greg.com. He got a call from a famous YouTuber to donate money to Team Water, which helps build wells in Africa for clean water. And he donated $1 million. A week later, he got a WhatsApp message from Team Water inviting him to join a group with the YouTuber and some billionaires. After a week in this group chat, the YouTuber announced he had early access to a new Coinbase crypto coin and wanted to share it with donors. Everyone got excited, started investing. Eric said he didn't know much about crypto, but didn't want to be left out. Over 3 days, he sent 1.2 million in 3 different rounds for this coin. Just as he was about to invest more, something felt off. He called the real YouTuber to confirm. The YouTuber had absolutely no idea. Everything was fake. The WhatsApp group, the people in it, the trip to Africa, all fake. You can be the smartest person, have millions in your account, and still get caught in something like this. Be really cautious. Put as much money as you can into sensible investments that you understand before doing anything you might regret. And on that note, one of the most sensible investments you can make alongside investing in assets is investing in yourself. But it is very worth being intentional about where your money sits and making sure it's working as hard as you are. If you've got here wondering what to do, the takeaway isn't to panic and move everything tomorrow. Step 1, calculate your emergency fund number. Multiply your core living expenses by 3, 6, or 9. Save that somewhere you can't touch it, can't see it, and that's paying you a good interest rate, around 3 to 4% right now. Step 2, outline your short-term goals. Anything you want to do in the next 5 years. You can save that in a higher interest savings account or a fixed term account. For everything else, your long-term wealth building, get it invested in diversified index funds, specifically through tax-free accounts. Target date retirement funds, even robo-advisors are worth looking into. I won't go into detail here, but I've got lots of other videos on this channel that cover this in more depth. And third, make sure you're subscribed. We post weekly videos on how to manage your money in a way that gets you closer to your life goals, in a way that isn't overwhelming, intimidating, or making you constantly feel like you always need to do more. Thank you so much for watching. I genuinely appreciate every single one of you.